Hello investors, this is Lukasz Labedzki, Senior Analyst at the Franklin Templeton Institute. Each week we'll cover the most important developments for investors, we'll look at what happened and how it impacts the markets so you can make smarter, more informed investment decisions. Today, let's talk about central bank policy, as the last 2 weeks have been packed with central bank meetings. Last week we had the Fed, the European Central Bank, the Bank of Canada, and the Bank of Japan. This week we've already seen decisions from the Reserve Bank of Australia and Sweden's Central Bank, while the Bank of England is still ahead of us as we record this early on Thursday. And of course, I'm not mentioning every central bank out there. What have we learned from those meetings? Central bankers have become a bit more cautious, with many of them on pause or adopting a more defensive tone in their communication. Just look at the Fed and Chairman Powell's statement that a December cut is far from a foregone conclusion. However, in most cases, there is still a long way to any hikes, and in fact, more cuts are expected. When we take a look at the chart, we can see that global easing across both developed and emerging markets is in full swing. Our dataset shows that almost 95% of central banks globally are easing policy. That's quite impressive and not without its consequences for the economy and financial markets. So, where are we headed? That becomes a natural question. The chart shows market expectations through the end of 2026 for major developed market central banks, as well as for the average emerging market central bank. As you can see, more cuts are expected in all cases except the euro area. The European Central Bank started easing a bit earlier than its developed peers and has moved a bit further. It continues to emphasize that 2% is a good place to be, and indeed, better than expected third quarter GDP growth, improving soft data such as PMI indices and ongoing fiscal stimulus all give it confidence that it is in a quite comfortable position. If anything though, risks still seem to be tilted more toward further cuts rather than hikes. The emerging market complex looks interesting as well. Of course, it's not homogeneous, there are quite a few differences between countries. However, on average, EM central banks are expected to deliver around 3 more cuts through the end of 2026, which should be supportive for EM local debt yields. What's more, both EM currencies and yields have shown resilience following the Fed's recent more hawkish press conference. What does it all mean for the fixed income portion of your portfolio? In the past, we created a framework based on monetary policy. It is built around the United States, where we have access to a wide range of data, but the implications are global. We can identify 4 phases or 4 quadrants of the cycle. The vertical axis answers a fairly simple question, whether the central bank is cutting or hiking interest rates. The horizontal axis answers a slightly more complex one, whether rates are still tight or already easy, that is, accommodative. According to the model we use, we are now in quadrant 4, where monetary policy is still in an easing cycle, while interest rates are already stimulative. The base case is that we may move even further into easier territory. Historically, this has been quite a good environment for bonds across the board. However, Two sectors have delivered significantly better results than average: corporate bonds and emerging market debt. These conclusions are based on historical performance analysis going back to early 1970s. Of course, standard caveat applies. History doesn't necessarily repeat itself, and while central banks are very important for fixed income assets, they are not the only factor driving bond prices. On the positive side, there is a solid economic rationale behind this pattern. If the economy is doing well and central banks continue to ease policy notably, while fiscal policy remains stimulative, it all acts like adding fuel to the fire, shifting investors' preferences toward riskier bonds such as corporate bonds and emerging markets debt. By the way, both of these sectors were reviewed in our earlier videos, which we encourage you to check out. On the flip side, valuations are not cheap. Spreads are relatively low for both corporates and emerging market bonds. And despite the generally supportive backdrop, this calls for a more selective, more active approach. Thanks very much for listening. Trade well. Cheers!